Good morning, everybody. Thank you for joining us this morning on this webinar on discovering the market value of your business. This is actually a follow-up webinar. This same group, we hosted one about 60 days ago, probably 2 months ago. So today's goal is to talk about maximizing value in the market and actually get somewhat specific as owners or service providers on ways to maximize that value of a business. Just a couple housekeeping items. If you do, we do have some a Q&A box. If you do type a question, we will try to get to those if time permits. We do have a lot of information to cover, so it will just be depending on our availability on time towards the end. Also, there are poll questions that will be launched throughout the webinar. They're not required to answer. They're more for us to gauge where attendees are in a potential process. And just as a heads up, unfortunately, this webinar does not qualify for CPE. So to begin, we'll make some introductions. We'll start with Paul. You want to introduce yourself?
Absolutely. My name is Paul Evans. I'm one of the partners here with CRI Capital Advisors. Usually I'm on the front end of a deal. So if you're thinking about, I wonder what my company's worth, I'm wondering what it might look like to go to market, I'd be the one that you would speak to. My background is that I've been a business owner since the 1900s. I've been a partner or an owner in 11 different companies. So I definitely understand not only the entrepreneurial spirit, but also just how critical it is to get not just the maximum value for your company, but also that you're getting a great partner and a great fit with your company.
Thank you. Brandon?
Yeah, thanks, Mark. I'm Brandon Maddox, partner with CRI Capital Advisors. I've been here for about 10 or 11 years now. And really, whereas Paul is involved very much on the front end of the process, as far as explaining, what's coming and what we're going to be doing. Once somebody has finally decided that they want to sell their company, that's when I get involved to a greater degree, and really are involved just in every element of the process, whether it's underwriting or marketing or diligence, going through all of those detailed items, that it takes to sell your company.
Great. Joel?
Hey, thank you, Mark. Appreciate everybody attending today. I'm partner and managing director here at CRI Capital Advisors. I've been with this firm for 14 years, almost 14 years. I've been doing M&A work for, let's say, 16 or 18 years. I came up in a family-run business, served as CFO for what was my father's company, and have that perspective, the closely held family-owned business. I bring that with me into the M&A side of the equation. So I have some general oversight roles, but I also directly represent some of the clients as well. Brandon will take lead on the actual process for some. I'll take lead for others. But regardless, we're very collaborative here. You get the whole team when you sign up with CRI Capital Advisors. So we all work together really well. And again, appreciate everyone being here today.
Thanks. Thanks, Joel. My name is Marc Berry. I'm a partner in CRI CPA firm. I'm a partner in the Transaction Advisor Services group. I'll be moderating today and look forward to a good discussion with these gentlemen. If I was in charge of the poll questions today, the first one I'd launch right now and just ask of the four of us, which one looks closest like our intro picture. I think we're all slightly older, but anyway. All right, so again, today the goal is to talk a little bit about how to grow value of a business before going to market, and then also just a little bit of understanding on how the market gauges and comes up with how businesses are valued. There's the old adage of my company's worth what someone will pay for it, or an asset is worth what someone will pay for it. But we do believe that there are things that can be done ahead of time to help drive that value up. And that's what today's goal is, to talk about a few of those items. Paul, just before we get really kicked off, just could you walk us through high level how businesses are typically valued?
Yeah, we're going to really dive into this deep into these 5 elements. But when it comes to the value of a business, sometimes it's easy to feel like, well, my business is valuable because it's making me personally a lot of money. But the real key to understanding value of a company is what's it going to look like to the buyer or to the next acquirer, because that's where the true worth lies. You know, what we do more than anything else is that we sell profitable companies. And to make sure that the right expectation is set, we begin with what's called a market assessment, and it's going to cover these 5 elements. So when you think about valuing your company, don't simply think, well, just how much is it worth overall? You want to be thinking about, what's my mission? You know, what does this deal need to look like? Why am I doing this? How does this need to go down? And the mission actually sets the tone a little bit. Secondly, you got to look at multipliers, and we'll dive into that. And often people will say, I heard a buddy of mine sell for X, 5X, 10X, 20X, and that's the multiplier that they're really mentioning. And sometimes we feel like, well, if I've got that one piece, it's all I need, but you really need all 5 elements. The third is the market activity. How active is the market right now? How is the appetite? How many acquirers are active in the market? And that's a big part of the research that we do, because we're able to see who's active. Then fourth is market sounding. And that's actually talking to acquirers to see what they are thinking about the market, what types of companies they're looking for, what types of numbers they're paying, how large is their fund. And that will play as well as to the value that you'll actually receive. And then finally are the market drivers. There's actually 7 of those. We're not going to cover all 7 today. We're going to look at one of the primary ones, but those as a collective allow you to lift your value. So when we talk about what your company is worth, what your value is worth, it's a lot of different components. It's not simply, I've got a great company.
Thanks, Paul. Appreciate the overview. So you mentioned the first one, market mission. So let's kind of gain an understanding of, process. So Brandon, just, to begin with, could you explain why it's important for a business owner to know why they want to sell?
Yeah, that's a great question and a really great place to start. And maybe, a business owner may think, well, I've made the decision, I want to sell because I want to sell. It's time to sell. Anybody that's gone through this process or has known someone that goes through this process knows it's a lot of work. There are a lot of steps along the way. There's a lot of frustration that can come in. There's a lot of emotion that can come in, which can be a real surprise to a lot of business owners. They think, okay, well, I've made just this technical decision. I'm going to sell my company. I'm just going to walk through these steps, and at the end of it, it's going to be sold, and that's done. But there are a lot of really emotional things that come along with it. And I say all that to mean you've got to have some touch point to come back to in this process that's long and it's tedious. Not to dissuade anybody from doing it, but just giving you a really honest view of it. It's just, it can be a hard process. So to know the why, to know, okay, yes, I've run this company for the past 30 or 45 years, and now I'm looking to maybe spend more time with my family. Maybe I don't want to leave. Maybe I'm tired of doing this by myself. Maybe I want to bring on a partner that can help me shoulder some of this burden, whether it be the financial burden or just the mental burden of just running a company and having all of these employees and customers depend on just you. That can be taxing, once you've done that for a number of years. So to come back to that point of knowing why and reminding yourself, okay, yeah, there is a reason outside of just it's about the money or it's just about growth. No, there is some personal reason. There's some why I'm wanting to do this. That can just be a real value to you when you find yourself in some of those dark corners of looking at a list of diligence questions that are 300 long, and you're like, why am I doing this again? What's the reason for this? Do I really want to do this? Having all that, kind of thought through on the front end can really help you make it through some of those tough times. So that's really, to me, why the why of it is so important.
Thanks. So yeah, having that carrot, I guess, out, or the really understanding what the end goal is probably very crucial. And really to know at the beginning, I assume, Brandon, I'll ask the question. I assume is it better for a business owner to sell on their timetable versus out of necessity?
Yeah, 100%. You know, the best time to sell is when you don't have to. You know, yeah, come up with that why, understand the driver behind that. But if you're selling because you have to, maybe there was some unforeseen life event that comes up, whether it's health related or, you know, maybe one of your major customers, you know, left and you feel like it's not, or the market's not doing what you wanted it to, or even on the other end, maybe your company's doing better than it's ever done, and you feel in the pressure of, oh, I've got to sell at the top end of this, or you know, or else you're going to find yourself at a disadvantage because the people that you're going to talk to, these professional investors, which are good good ladies and gentlemen, all of them, you know, we've had a lot of good experiences, so not to disparage them in any way, but this is what they do for a living, and they can absolutely smell a bargain because that's what they're looking for. So if you go out and you're selling because you have to, you're just putting yourself at a disadvantage. And that's not to say that you can't run a really good process and have a really good outcome when you have to sell. We have done plenty of those, but it's always better to be able to do that when you're not in some type of a crunch. When you've got the time to think through it logically, you've got the time to prepare, you're going to have a much more easy process and likely a better outcome.
Yeah, thanks, Brandon. So Joel, you know, as we go through sell side diligence on our team or buy side diligence, you know, you hear asset sale versus stock sale, equity. You know, there's different ways to sell a business. How important is it, or is it important for a business owner to have an understanding on how they want to sell their business?
Yeah, I really think it is. Brandon did a good job of explaining some of the elements of the why, but the how was important too. You know, the process is going to involve some fundamental elements. You know, we're going to do buyer research. We're going to assess the value up front. There's going to be certain data that we need, but we do clients a disservice if we go the cookie cutter route and just kind of propose, hey, here's how CRI does this. You're welcome to participate in our process with your business. That's just wrong. That's the wrong way to think about this. So we do want to help the client think about, how do I want to sell this? So, you know, Mark, you mentioned asset versus stock sale. You know, we always hear, well, stock sale is the best. You get better tax treatment, and that can be true. But there are also closing or post-closing elections, as you well know, that can sort of negate the benefits of a stock purchase. So we're watching for the overall structure. There are some ways to structure deals that matter. So what type of sale does this need to be? What type of process do we want to run here? You know, to often to get every dollar in economic value out of the company, that may require a broader auction type process. You may not want to go that route. There are some pitfalls. There are some challenges you have to navigate with that. So do I want a broad auction? Is this a narrower, more quiet process? So I really do think you have to think about the pros and cons of each type. And then as your advisor, we have to think about, hey, here are the elements that have to exist in the process, but how do we tailor those, not only for the maximum outcome for you as the seller, but also to meet those how needs that you have real foundation for.
Thanks. You know, I know you guys have gone through a lot of these processes. You know, we talked a little bit, Brandon talked about the why, you just talked about the how. Are there other things that business owners should be thinking about to decide when the time is right?
You know, I think you have to think about constituencies, right? Think about, okay, maybe husband and wife own a business, or maybe it's a small group of partners. You obviously are going to think about that group of owners, but outside that ownership circle, there are employees, there are customers, there are non-owner family members. This may be a major sort of legacy type event for a family that impacts the future of family members not inside that ownership circle. How are customers going to react to the transition of the business? So I do think from that perspective, it's really, you have to think about this business from a global perspective, like not just what is my outcome, what is the number I need to retire if retirement is the goal, but you do have to think about sort of all the spheres that sort of overlap and are involved in this.
Thank you. Brandon talked a little bit about I don't have to sell, right? Or the best time to sell is when you don't have to sell. I'd be curious, Paul, as we go through diligence on my team, we hear that phrase a lot, and usually it's out of frustration, right? Brandon talked about a 300 question diligence list, and that usually starts the conversation of I don't really actually have to sell, so I don't want to answer these questions. But how detrimental, in your view, how detrimental is that thought process? I don't have to sell, either before or in the middle of a process.
To me, it's kind of like, I remember when I was a kid, my mom would get on to me because she said it was something about my tone. I was like, what do you mean it's about my tone? I said X. She said, it's not what you said, it's how you said it. So that's what this really is like, that I don't have to sell. If it's a matter of, I'm going to market, I don't really have to sell, I'd like to sell, that's a great position to be in. If it's, I'm going to get my way and I just don't have to sell, and it's more of a threat, then it is detrimental, because number one, what they're often looking for is a partner, and they're also looking for a culture of the company. And if that type of tone or attitude is prevalent, it makes the deal more difficult to get done. And it can, not always, but it can actually lower the value because of just a level of difficulty. Another aspect to be thinking about in that is that everybody who's involved, including the owner herself, is going to be committing to a 9 to 12 month process. So it's a lot of time in. So if out of the gate you say, I really don't have to sell, well, a buyer may think, I don't know that I really want to put a lot of time in if this person really doesn't have to, if they're going to have an attitude about it. And there's going to be hundreds of thousands of dollars spent in the process of getting to the finish line. And so not only is there a lot of time invested, there's a lot of money invested as well. So yes, be positioned in that you don't have to sell if you don't really get a good offer, a good partner, but not the attitude of a threat of, I just don't have to, and everybody's time has been wasted, including the owners. So it's more of just being cognizant of the position of that statement.
Yeah. Thank you, Paul. All right, we're going to launch our first poll here, and while we move on to the next point. So the poll question: where are you in the process of selling? We got 4 options there. So while we're waiting for people to answer, give that a little bit of time. Market multipliers, again, at the very beginning, Paul, you talked a little bit about market multipliers and what multipliers are. And Joel, just kind of curious, how do comparable deals affect a process or the value of a business?
Well, comparables are very important. And we always look at them. The downside of comps is that they're rarely exact. So I could have a manufacturing company in a very specific industry, and I could find another very similar company that had transacted, and I may even be able to see the valuation data on that company. But that company may have been fully automated, extremely tech enabled, a little more cutting edge than my company, and it's going to be a bit of a different multiple. So the comparables do a great job in providing some parameters in which we need to start thinking about valuation, but they're not necessarily the end all be all. We have some great resources like we have here on the screen that enable us to see what normal market multipliers are. But I use a term in the office sometimes, triangulation, because we're pulling from so many different data sources, and then we're kind of overlaying some judgment and some experience, some feedback from buyers, all the data we're consuming. We then have to just apply some know-how to this and say, okay, given all of these data points, including market comps, here's what we think your company is going to be worth. So extremely valuable as a data point, but not something that gets so fixated on. It's not as easy as going to a database and saying, oh, here's my multiple, here's my profit, therefore I require exactly X for my business. It's a little more involved than that.
Yeah, thank you. So before we move on here, just looks like we're kind of rounding out the poll. So I'm gonna leave that up for just a few more seconds while while we move on, and then I'll kind of summarize it. So, Brandon, we talked a little bit in the last point about I don't have to sell. This is another phrase we get a lot, which is, my buddy got X times for their company. I'm just kind of curious, is that, how helpful is that?
I'd say not very helpful. Rarely, if ever, have I heard that my buddy got X times for their company and it was less than what I was currently being offered. So it's an interesting dynamic of everybody's friend got paid more for their company than what they're currently getting paid, and that's a universal constant, or seems to be. No, it's not particularly helpful. And really it's for a lot of the reasons that Joel just mentioned. It's really hard to say, even if, okay, I have a manufacturing company and I'm making, widgets of a certain type. And let's say my buddy's got a manufacturing company and they're also making widgets. But then you have to start comparing, okay, what's your customer base look like? Maybe I'm making widgets for the aerospace industry. Maybe they're making it for the lawn care industry. Neither one of those is better than the other, but those are viewed differently in the marketplace by investors. So not only do you have to look, okay, yes, is it the same type of company? But then we can go on to look and say, okay, what's the size of these companies? Are they comparable in size? And a size premium is a very real thing. Investors are going to pay more for larger companies because there's likely less work that they're going to have to do to grow it to that next level. So size would be one. Another one too that's a little harder to for a lot of business owners that we talk to really dig into and really get good intel on is what was the structure of that deal. So maybe your buddy did get 10x for his company, but if they were willing to just say, okay, here's the piece of paper, here's the offer, here's exactly what it was, maybe you could compare. But you don't know, okay, maybe your buddy got 50% of that in cash, and maybe the rest of that was in some type of a really hard to get earnout. Well, that may not be comparable to what you're actually looking at and what you want to do. So it's just, we've rarely found, if ever, that you can even the deals that we work on, take my buddy's company out of it completely. The deals that we work on, it's hard to compare one to the next because each company is just so different from the other. And there's just so many, details and nuances that go into valuing a company. So rarely does that help the conversation. Typically what that does is it takes what is probably a really good offer for a business and it kind of sours it against something that's really just not comparable, and it ends up doing more harm than good. Maybe save those conversations for after you've closed and you're around the campfire talking about, what you used to do for a living and how much you got paid for your company, but don't let that impact what, the decisions you make as far as selling your company. So
yeah, it's a good point. I guess not only are companies different, but also consideration, right? In the deal structure, like you mentioned, it's a good point to remember when you're comparing and hearing war stories about your buddy's company. So from a poll question, just, we got about 75% that answered. Kind of interesting split. About 10% are in the market, about 13% are ready to go to market now, and then about 70 or the remaining answers are 1 to 3 years out. So kind of an interesting split there. Surprised to see how many are actually already in the market or are ready to go now. So Paul, we have this the multiples here on the screen as an example that Joel kind of touched on. Just curious, is this something business owners can find? Can anybody find this data? You're on mute there, Paul.
The data itself is really difficult to locate if you're not a member of a subscription like this. Like if you go out and search Google, how much are manufacturers worth these days, you're going to find a lot of numbers. Most of it is probably not accurate simply because most articles that are written on the top level outcome. It's like a highlight reel. Those are the numbers that are usually shared. Also, what's easily available is the publicly traded companies, which again tends not to be the type of companies that we represent. And most of our clients are not at that $500 million to $1 billion and beyond level. We deal with a lot of business owners that are anywhere from 10 million to 200 million. And those multiples are difficult to find without being subscribed to something like this or PitchBook. And really, you almost, like Joel was saying, if you're going to triangulate, you got to be a member of several sites. You got to have a lot of connections to be able to pull all this together. Not to say that it's impossible. It's just fairly difficult, and it will cost anywhere from 30 to 50,000 a year to be a member of these tools in order to receive that level of information.
Yeah. Thank you. So Joel, Paul just talked a little bit about Google and whatnot. Should business owners, should they be worrying about this level of detail with multiples and whatnot? And I guess a second question is a business owner, are they able to change how the market values their business or looks at their business?
Yeah, I think the answer to both questions is yes. I would encourage business owners not to get fixated on tracking multiples. Couple of reasons for that. One, as I mentioned earlier, it's not the Bible, right? It's not the end. It's not simple math. It's so tracking your industry's multiple over time, while helpful, is not just the end all be all in terms of valuation. This is the charts you're showing here, Mark, are actually related to debt, but I think we would see similar trends if we were looking at actual valuation charts. You're not necessarily going to see wild peaks and valleys in these multiples over time. So as you can see here, this TEV is total enterprise value, that 10 to 25 million total enterprise value. Think about that as selling price. You can see the amount of debt put on these deals over time doesn't change dramatically. So in your industry, it's kind of unlikely that last year my business was worth 5 times EBITDA, and this year it's worth 9 times EBITDA. They just don't swing that wildly. If you were worth 5 times last year, maybe just on its face, maybe that has shifted by half a turn at the most. And that's generally what we see when we look at historical multiples. So tracking it's valuable is good information to have, but not necessarily something to get sort of stuck on. You can change your multiple more than just watching it. There's what's known as a size premium. So by growing your business, you can actually move into a different bracket of multiples. So you can grow into a bigger multiple. We often say data drives value. So if you're one of those 2 or 3 year out kind of people, what can I do in terms of my reporting, both financially and operationally, that just provides absolute clarity on data that can drive some additional value? Maybe I've been sort of a one-man show, even though I might have 100 employees, but I kind of drive the business. Maybe I need to start stepping back a bit. Maybe I need to empower a second tier of management. Maybe I need to hand off some key customer relationships. For an acquirer, value is a function of risk, really. And so any risk factors that I can diminish as I prepare to sell my company, or at least explain how they can be diminished, those things really add value. So multiples are super important, but there are some levers you can pull to actually shift your multiple a bit.
Thanks. And while we're on the subject of maybe things business owners can change, if everything, if the stars aligned and a business owner was really thinking through the process, how early or when should a business owner start preparing a go-to-market strategy? Is it 1 year, 6 months, 5 years? And I'm throwing that out to anyone that wants to answer. I'll pick on Joel since you were the last one to speak. But if you gave business owner advice, how early should they be planning an exit strategy?
Yeah, well, it's kind of the Stephen Covey adage, begin with the end in mind. I mean, ultimately, even if you're 20 or 30 years old, ultimately you're going to need to transition the business. It may be decades in the future, or you may be within that sort of 1 to 5 year range. We can help a client really at any point. You may decide today, you know what, I just really need to retire. I'm tired of doing this. I want to do something different. We can absolutely work with that. If someone comes to us and says, hey, I'm ultimately going to sell my business, we can talk about, well, when do you want to do that? Because the process looks a little bit different. Do you have a year? Are you thinking more 2 to 3 years, 3 to 5 years? So earlier is better. A lot of times we find clients who've done a lot of the things they need to be doing. You know, they've been having audited or reviewed financial statements. You know, they've engaged a professional like you, Mark, to do a sell-side Q of E, so their numbers are super tight. And so sometimes clients come to us ready to sell, and they actually are ready. And Paul, I think you're the one that says there's a difference between wanting to sell and being ready to sell. Sometimes the seller just wants to sell. Maybe there's a little groundwork that needs to be done if maximum value is really the focal point here. A lot of clients come to us and they've checked a lot of these boxes already and they are truly ready. So I think it's important to surround yourself with the correct advisors as early as possible. We have relationships that go back. I think the longest one has been probably since I've been here, 12 or 14 years. We're still tracking with companies that just haven't sold yet, but we have a conversation 2 or 3 times a year. We do look at multiples for them. Hey, what's the market doing? You know, how does the stock market sell-off affect valuation? We're having those conversations, and one day they're going to sell. We invest in those type clients over time. I think, you know, we recently sold a company that was a 6 or 7 year relationship, and it was a great relationship. We were happy to track alongside them that long. So whether it's I need to go now, I would like to go now, or whether it's like, hey, give me a 5-year plan to really get this thing dialed in, we can address both of those needs.
Perfect. Thank you. So before we move on to the next slide, I'm going to launch our second poll, and then I'm going to touch base a little bit on some questions here just to so second poll question, do you have a research tool for accurate multipliers in your industry, right? So this is what we just talked about with the tools that everyone just chatted about. So those that have, there's been some really good questions that have been posted in the chat or in the Q&A box. Our goal is to cover specific items, so we might not get to those questions. The good thing is we do get a report of all those questions. And so we will, if we can't get to them on the webinar, we will definitely be reaching out and responding to those questions. So if we don't get to them, know that our goal is still to get them answered. All right. From a market activity standpoint, so Paul, how do you guys go about finding the right buyer?
Yeah, this is one of the reasons that we get involved, not only to be able to negotiate, make sure that the value is set appropriately, but to go out and actually find the buyers. We found that most business owners, they're ready to sell their company. If they've not been approached or they've just been approached by one person, they don't know how many other possibilities are out there. This happened just a few years ago. We got to work with an incredible company, one of the top ones we've ever worked with. And they said, hey, we know exactly who's going to buy us. It's one of these 3. They were very firm about it. We went and did a presentation and said, we really feel like it'd be positive to go to market and bring some other buyers to the table. And they were really adamant because they knew their market. And most owners feel this way. We know our market. We know who's going to buy us. Went out and used a research tool like you see on the screen and pulled together a group of buyers. And once the process was in full swing, those 3 that were absolutely going to buy this company weren't even in the top 10. So they didn't even make it. So we definitely got research and tools to be able to pull and access buyers. So the tools that are out there that we use let us know not only market activity and how active the market is, but we can see who is actually active within the market. And those are the buyers that we start collecting and we will ultimately approach with the permission of the seller. We'll ultimately approach because we know that they are actively acquiring in the space right now.
Perfect. Thanks. Brandon, just in your process, how much say does a business owner have in finding the right buyer?
Yeah, I mean, we always get, so we'll use, like Paul mentioned, we'll use tools like what's on the screen. In addition to, the three of us have a ton of conversations with potential buyers every week. We're listening to what they're looking for, what they're feeling about, particular markets, and we kind of pull all that data as well. But ultimately we kind of put that initial list back out to our client and say, hey, what do you think about this? Are there any on this list that you'd rather us not talk to? Because, there's going to be, especially when you get into like a strategic acquire, another company in that market who is making acquisitions. A business owner may have had a run-in with that, particular company, and we have no idea about it. And they may say, there's not a chance I'm selling to that person. There's not a chance I'm showing them my information. I don't care if there's an NDA involved or not. And that's good feedback for us to know. We like to try to minimize the amount of strike throughs that we get on that buyer list, because you're taking out people for most of the time. It can be a reason that's not really related to whether they're going to buy your company for maximum value or not, which is really what we're going for. We're trying to find that right fit. So yeah, I mean, a business owner is going to have some say for sure. In not only how their company is marketed, but who it is marketed to ultimately. But we really try to keep that as broad as is needed. Not every process is going to be the full, broad, hey, we're sending it to every investor on the planet. We don't typically do that. We use a targeted approach anyway. So if we come to a business owner with, a couple hundred buyers, they've all got a reason for being on that, initial buyer list. And we do give the opportunity to take some of those off, and we have a conversation. So yeah, I mean, there is some say in that. But we try to caution, the hey, let me get out the red pen and strike off half of these, because that's typically not a good situation.
Yeah, that makes sense. And Joel, how does having representation, right, an investment bank, how does that assist an owner in finding the right buyer and really adding value to the transaction?
Yeah, it's a great question. And, I think part of it is that we can see behind the curtain a little bit. This is our world. This is what we do for a living. I always tell our clients, for example, I had a client, we had a client that did complicated commercial industrial HVAC work. And I told them I would never walk onto your job site and tell you, hey, the tonnage on that unit is wrong, or hey, that ductwork isn't right. So, they know their world. They were absolute technical experts at their business. This is where we live every day. So we are listening for certain things from acquirers. There, this industry has its own language. Just as a quick example, if an acquirer refers to themselves as a value investor, that's kind of a signal to us that they're not going to pay top dollar. They're more interested in future growth, and they'll allow you to participate in that. But when, value investor, that sounds like it's positive. What we hear is maybe some conservatism that we might have to address on the valuation front at some point. So we're just listening for those cues that you as a professional in your space might miss. Whereas again, if someone were speaking your lingo, it would go right over my head, right? I wouldn't know the technical terminology for your business. So we can help in that respect. We can see who has money and who doesn't. In most cases, again, we're listening for those that are saying the right things, and to indicate, hey, we have cash in hand to do this, or they may imply we're going to go out and raise this capital. Not a terrible thing. And we completed deals with, they're called independent sponsors. They don't necessarily have cash in hand, but they do have a lot of good connections. And those come in all different flavors. So we're listening for, okay, are you one of the independent sponsors that is just hoping to get us under exclusivity and then scurry to find the money, or do you actually have capital partners that you're going to bring to the table? So I think having representation, not only helps you identify the correct acquirers and the quality of those acquirers, but it just helps prevent some risks. I won't call any names today, but we have a list of acquirers that have a history of retrading late in the process. And so we can just kind of know, hey, this group, man, they're selling us the sunshine. They're saying all the right things. Their valuation is strong. And every time we've come across them, they've lowered their valuation late in the process, kind of hoping it was too late for the seller to change his or her mind. So just a little bit of that inside baseball knowledge, can come to bear when you have an advisor on your team.
Yeah, makes great sense. All right. So for the second poll question, about the tools, as we would expect, not many people have access to those tools, or pay to have access to those tools, I should say. All right. So the next, Brandon, could you explain? I know Paul talked a little bit about market sounding at the beginning, but could you explain in a little bit more detail what market sounding is?
Sure. Yep. So this is another one of our tools that we use when we're trying to, understand valuation in a particular market on the front end, and then also get some intelligence on, active buyers. But market sounding is really just talking to the people who are acquiring. We can tell based on some of the tools that we've got, the conversations that we're having, we can tell who's buying in a particular market. And it's super helpful to be able to talk to those groups and say, okay, tell me what you're looking at in this market. We're not necessarily weighing or hanging our hat on what they think about value, because they're, again, an investor's trying to get a deal. We're trying to get maximum value. Those things are opposed in some way, and you have to meet in the middle. So we're not hanging our hat and saying, oh, they said 6 times, that means all we're getting 6 times. But to understand, okay, maybe we'll go back to manufacturing. Maybe there are some certain metrics that they're looking at every time they're acquiring. And then we can take that back and we can say, okay, hey, do we have those same metrics? Are we even able to measure those things? Are our clients looking at the right things? Are they focusing on the right things and are going to be able to report and to give, what these active acquirers are looking for? Are we going to be able to answer those questions? So it's just really valuable to be able to talk to the people who are actively acquiring in a particular space. And we do that quite often with most of the processes that we run, talking to those people that we can see, okay, you've made recent acquisitions in the past 6 months. We want to have a phone call with you to understand what those have looked like, whether it's, like I say, metrics that they're looking at, whether it's structure, all of those things, and valuation too. We get that as a data point, but that's not where we're hanging our hat on. We're just saying, okay, yeah, this is what people are likely paying for companies in this industry. We put that together with the other information that we've already discussed. But yeah, market sounding is a key piece of just understanding what a market's doing.
Yeah, just constantly staying up on the process, right? I guess.
Yeah.
Really keeping your pulse, or your finger on the pulse. Yeah. All right. So the last, we have a couple more poll questions, but we'll launch this next one. Do you have 10 or more acquirers in your space you remain in contact with to receive market feedback? Right. So very similar to the market sounding, but from a business owner standpoint. So Joel, from a market drivers, could you provide us with, maybe pros and cons of an auction process versus working with an unsolicited offer?
Yeah, they're obviously very different processes. So some of the pros of a broader auction process is that it's competitive. Acquirers will know, they won't know one another's names, but they will know this is an open process. It's confidential. Everybody's signing NDAs before they even learn our client's name. But they're going to know, okay, I'm one of many that are pursuing this deal. We do have some acquirers that will tell us, they refer to them as proprietary deals. We only participate in proprietary deals, which means I don't want to compete against anybody else. And that may be okay, but it at least signals to us kind of where they're coming from and what type of acquirer. It implies some other behaviors we're likely to see from them. Again, not negative. It's just a point of information. But a broad process, again, it's competitive. It's kind of a no stone unturned approach. I mean, you're gonna know we have fully vetted this market. So if you're one of those people who can't sleep at night thinking they might have gotten $1 more, maybe a broad process is for you, right? We're gonna have a broad audience. You're gonna receive multiple indications of interest. We're gonna narrow that down. You're probably gonna have multiple offers. You're gonna pretty well know, okay, we cast a pretty broad net. We ran a good process. This is where it's landed. I can be confident knowing that we did what we were supposed to do here. The downside to that broad process is that there is some exposure. And again, we're signing everybody up under NDAs. It is rare that we have what we would consider a breach where it gets out in the open. But with a broad process, we may go out to 200, 300 potential acquirers. We may narrow that to 6 or 8, maybe 10 who have said the right sort of preliminary things. They've given us a written, it's called an indication of interest, where they informally say, we think the business is worth X. Here's generally how we would structure it. It's totally non-binding. They're totally not on the hook for that. They're at least saying, are we in the ballpark? Can we continue the discussion based on these really high-level terms? You may have 5 to 10 of those that are worth pursuing. Well, most likely they're going to want to come see your facility. They're going to want to meet you in person. So do you want 5 or 10, tours through your plant? If absolute maximum economic value is your primary focus, it's probably worth it. If you're concerned about your employees finding out, if you're concerned about your customers finding out, maybe you want a little quieter, a little less intrusive process, and we can tailor that process. And it's really not an all or nothing. You don't have to blast out to the entire acquirer universe of 30,000 possible acquirers. You also don't have to limit it to 2 that you can name offhand. It's a spectrum of how we can control the process. So upside and downside to both of these. On the unsolicited offer, you're dealing with one acquirer and they know they're not competing. And that may be fine. You may think, I don't have to have absolute maximum value. I would really like to do this quietly. I would like for this to be at as little disruption to my business as possible. I've talked with this acquirer and I really actually like them. I would like to sell my company to these people. We're working with a client right now that is in this situation. They were approached. They have a letter of intent in front of them. They like this acquirer. I asked them, do you want to sell to this particular acquirer? We would really like to if we can, was their response. And with a little bit of research, we've discovered that the valuation probably needs some work. But we can come in, we're not brawlers, we're not street fighters. We don't come in, pounding the table. It's going to be X valuation or hit the highway. We come in to facilitate and go, hey, here's our mandate. We've been employed to help get this deal across the finish line. Let's talk about valuation. Let's talk about some key terms that maybe need some attention. We can do that in a very conciliatory manner. So both the broad auction and the unsolicited inquiry work. It's just going to depend on what the seller is looking for.
Thanks for that explanation, Joel. So Brandon, this last bullet point here on data. Can you just quickly talk about the importance of data and maybe brief example, some types of data that are important to help increase value?
Yeah, for sure. So you got to think it from a buyer's perspective. So even though they may be buying companies in your space, they don't know your company. The purpose of the data, whether it's financials, whether it's operational metrics, it's for them to understand your company. And the data is really going to start from day one. It's going to be the information we give them initially under NDA, and it's going to continue through the day of close. And there's a lot of pieces in between. So yeah, financials, obviously everybody expects to be able to provide financials. Operational metrics, that gets into a little bit of the discussion about, okay, preparing ahead of time. How able am I to report on sales, on customers, on vendors? Some other things people may not think as much about. that really have an impact on value because they decrease risk for a buyer because they get an understanding of, okay, yeah, I have a full picture of this, but can you report on your employees? Can you report on payroll? Can you report on insurance? If you've got contracts, do you have the full version? Is it the signed version? All those things may seem small, but you kind of have a buildup, this snowball effect of, oh, well, they didn't have this piece of information. Oh, and I can't find this. And after a while, a buyer gets to kind of a breaking point and they're like, okay, I really don't have a good feeling about this company. Maybe I like it on the surface, but when I start digging in, the pieces are just not fitting together. So if you've got time to prepare, get your house in order from a data perspective. Yes, financials, and there's levels of those. You could go from, just internal QuickBooks reports to, okay, maybe you need to have a reviewed financial, maybe you need to have audited financials. If you've got the time and you were really serious about it, Marc's group does, quality of earnings, being able to really dial in and say, okay, well, how's a buyer going to look at this? How can I defend this? There's just so many pieces when it comes into that data, but really just, like I say, getting that house in order, being able to report on all of those important pieces, it does make a difference for valuation.
Yeah. And just a quick follow-up. Any recommendation on how far back? I think actually one of our questions is how far back should I have data?
Yeah, normally I'd say, and it depends a little bit on industry. If you've got 5 years of solid reporting, that's about as far as we see. On a rare occasion, I've seen it go back further, but 5 years is a pretty good place to be. If you feel pretty solid about, whether it's sales reporting, whether it's, just the base financials, operational metrics, obviously that'll help as well. But yeah, 5 years is a good place to live.
Yeah. One piece, there was a question in here about COVID, right? In the middle of our, the last 5 years. I probably won't answer the very specific question, but from a COVID standpoint, I can tell you from our clients, when we deal with buyers on the buy side diligence and the sell side diligence, a lot of times they're looking at the years before COVID, and then they're almost skipping 20, and they're looking at 21 and 22 more as a recovery on how quickly were you able to bounce back from that disaster. And it really depends on your industry, right? So supply chain, we know, was a big issue. But it is interesting how kind of buyers, at least from our view and with our experience with our clients, they're really just almost as if 2020 didn't exist, and really half of 21, the first half of 21 didn't exist. It's really how'd the company do from the middle of 21 onward, just because it was just something that we've never experienced it before, and so no one really probably knows how to look at it, right? So the response to our last poll question is the majority of people did not have buyers in the industry that they kept in contact with. So our last poll, I'm going to launch that. Would you like to have a market assessment performed for your company? And while people are responding to that, Paul, we'll let you kind of wrap it up. Any last thoughts that you'd like to share?
Yeah, probably just tied right in with this poll question is that's really where we begin with the market assessment. So if you're interested in what your company may be worth going to market today, that's the great starting place, because you might get the number and decide, man, I need a lot more money than that. I've got to get on it. Or you may see the number and feel like it could be time to start exploring. And so if you're ready now for a market assessment, if you click that top box, then I'll definitely reach out, or you can reach out to me, Paul at CRIEDV.com. My cell phone is 334-328-0988. Feel free to reach out on that. And then constantly these 5 elements that we've talked about today, allow those just to be a continual process for you, continual to think about those things, to focus on those maybe once a quarter, to run back through it, to make sure that you're just staying on the top of line of all of these, especially on those data pieces that Brandon was just talking about. We can handle a lot of the heavy lifting on the multiples, on the market sounding. That's just part of what we do. And so we're happy to serve in any way.
That's great. Thank you. Yeah, as of right now. So about 20 people said that they're ready now for that market assessment. Paul was brave enough to give his cell phone number out over the webinar, but on the screen right now is all of our contact information via email. And on our website, I think all of our phone numbers are listed anyway, but feel free to reach out to us. For those questions that did not get answered, we get a report of those, so we will definitely be in contact via email to help answer those questions. We do appreciate everyone's time today for participating. And again, any questions that we can follow up on, please do not hesitate to reach out to us. Everybody have a great rest of your day.